All right, some CEOs leaving their posts 30 minutes until the start of cash trading. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, Pat Gelsinger retires instantly as Intel CEO after a storied career. Well, it was some story to the downside. The company he's leaving lost 50% of its value in the last 5 years. We'll have the latest on the new interim co-CEOs. Co-CEOs are always a great idea. Trouble under the hood. The Stellantis CEO also resigns unexpectedly as Volkswagen workers across Germany stage walkouts over the automaker's plan to cut costs. So a lot to talk about in the car space today. And most Black Friday shoppers bagged their deals online. We'll ring up the latest trends as Cyber Monday comes on strong. First off, let's take a look at these markets. Fairly calm after a positive November. We had back-to-back monthly gains, and we're kicking off December with very little movement in terms of futures. On the S&P, we're up 0.03%. NASDAQ futures up 0.2%. And the 10-year yield right now rising 5-6 basis points to 4.22, 4.23. Sonali, what are you looking at in terms of stocks?
A lot of calm over there. People still rolling back from their holiday weekends here. But of course, some companies rolling back strong. Gap being one of them, 4.6% higher pre-market. It's getting a boost after JP Morgan upgraded its rating on the apparel retailer. But then we're watching Stellantis falling more than 6.4%. Their CEO unexpectedly stepped down, stock taking a hit on that news. We'll talk more about it later in the show. Intel, as we've been talking about, jumping on the news that Pat Gelsinger is retiring as CEO, now up more than 4%, Matt.
All right, we're going to continue on that story right now. Joining us to talk more about it is Mandeep Singh of Bloomberg Intelligence. Mandeep, Pat Gelsinger retires effective immediately. The company has I guess, no succession plan, so they put in 2 interim CEOs. Why?
Well, I mean, look, the turnaround clearly didn't play out the way he expected or the strategy that he laid out. And in this case, they're probably going to look for somebody externally to come in. Pat also came from outside, by the way. But clearly, he tried to take too much on in terms of turning around both the design side and the foundry side. And in this case, my bet would be anyone coming in is going to pick a side. Is Intel going to be a chip design company or a foundry company? I think turning around the ship as is with both the parts is very hard. That's what we figured out.
How necessary was it to find a new CEO at this point in time? The fact that not only did they name interim CEOs, he's stepping down, as you said, imminently. Was it necessary to have new leadership in the middle of what's already a drastic turnaround story?
Well, so look at what has happened operationally with Intel. They've had a couple of rounds of layoffs, and the direction that Pat had laid out, not picking the side, as I said, has made it very hard for investors to gauge, is this company going to turn around even in the medium term? Because everyone anticipates a big PC upgrade cycle. Even though Intel is losing share on the data center side, the PC side, Intel is still dominating, and they are the incumbent player. So not participating in a PC refresh cycle would be a very big deal for a company like Intel. And I'm guessing the board didn't have enough confidence in Pat's strategy. So that's what it comes down to.
Not even enough confidence to leave him there for, say, a month while they find a new CEO to replace him full time. They had to have him out instantly and replace him with co-CEOs. What does this mean for the billions of dollars of government funding Intel is earmarked to get?
I mean, they'll still keep getting it because when you look at the precedent we have with AMD, AMD actually divested their foundry business into global foundries, and they became a design company. I expect something similar to happen with Intel because the government wants chip manufacturing to stay in the U.S. So if the foundry business were to be divested, then they would continue to get funding because it
As a designer?
As a manufacturer like TSMC.
So the foundries that they divest would continue to get the funding?
Yeah. And then on the chip design side, as I said, the PC business is still very healthy. It's going to generate its own free cash flow. So that may sustain on its own. So it comes down to whether foundry gets divested or not. And I think from a government perspective, they would continue to support that.
Mandeep, thank you so very much for being on set with us right now, of course, on this breaking news. It was only about a half an hour ago. Mandeep Singh of Bloomberg Intelligence. And joining us now on the broader markets, we're going to speak with Stuart Kaiser. He's head of U.S. equity trading strategy at Citigroup. And from what I understand, you're excited to shift gears here. There's payrolls on Friday. Market will quickly be shifting over to that. What are your expectations?
Yeah, I mean, the way the data is forecast to come out, it should be very positive for equities. I mean, consensus is about 200K on payrolls, still about a 2/3 chance that the Fed's going to cut on the 18th. So you put all that together, it does stack up pretty well for equities into year end. And I do think markets will take a little bit of a breather here from all the political headlines, hopefully just for a week or two.
We've already come so far so fast, right? I mean, we're up, 26% year to date on the S&P. Second year in a row with more than 20% gains. Do we advance significantly into year end? Does the January effect give us a significant boost, or what do you expect?
Yeah, I mean, I think our view is that you will rally into year end. Typically, early in the calendar year, you get kind of these rotations and things like that. So I think a lot of people are continuing to look at small cap as a little bit of a catch-up trade. You have very strong seasonality there. In addition, you have obviously kind of a Trump impulse going through the system as well. So yeah, we expect markets to rally into year end. We expect small cap to do well. I think as you look into 2025, it's hard obviously to envision another 25% year, 3 in a row. And I think the two reasons for that are probably valuation, A, does look a little extended, and then B, the earnings bogey for 2025 is relatively high for the S&P as well. So you are entering the year next year with a pretty high bar to begin with. So I think a lot of folks are looking at whether it's S&P equal weight, whether it's S&P small cap, Russell 2000 as potential catch-up trades early next year.
By the way, it does seem like we're only focused on the good parts of Trump 2.0 and not, I mean, like, we care about the tax cuts and deregulation, so we're rallying. And if someone mentions like mass deportations and tariffs, they say, that's just negotiation.
Yeah, I think that's right. Like, there's been three kind of primary election trades, I think. One is M&A targets. Those have been beneficiaries. The second is government spending. Those are more on the victim side. So I think that would be kind of the negative side of the Trump trade right now. And then you have this domestic versus foreign kind of imbalance going on. So domestic sales companies outperforming those international. So, I agree with you. I think, our view is election has 3 stages. You had the initial reaction, which was about sentiment. Now you're in kind of the policy proposal phase. Next year is going to be about implementation. And I think a lot of what you're talking about, those risks are really going to be activated once you actually start to see these policies get implemented. So we'll be eagerly awaiting that for 2025.
Stuart, hang on tight really quickly because I want to bring some more breaking news over. Supermicro is replacing its CFO, David Wygand. Remember, Supermicro has been under a lot of pressure, has short selling regulatory investigations here, and you are seeing the shares jump 11% pre-market, Matt. So I wanted to point that out as well because it's been a story that we've been watching. Yeah, and of course, a lot of executive changes on this Monday morning.
Executive changes and massive volatility continues for this name, right? SMCI is the ticker. They lost their... They lost EY, I think, and then replaced them with another auditor. And that caused double-digit drops, then double-digit gains, and now we see another pre-market double-digit gain on another CEO shift. So interesting story, yeah.
Into the market. But Stuart, back to the broader markets because there's another Trump trade. That's what we were talking about, and one was the Russell 2000. You had mentioned a potential room for upside. It just had its best month since the end of 2023. I mean, it was up more than 11% last month. How much more does it really have to run?
I think people are girding up for a really positive seasonal. 30 out of the last 38 years, you've had Russell 2000 up in December by an average of about 2.5%. So I think you have a seasonal impulse. You have a deregulation / growth impulse from Trump. And then, as I alluded to, you also have kind of this M&A story out there. And I think all three of those are incrementally positive for Russell 2000. So I think at least into year end and potentially into early next year, as you get these kind of rotations around calendar year end, we do think, Russell has some legs behind it.
It's amazing. More than 10% in 1 month for the Russell, right? The S&P for the month up 1%. So massive shift. And it makes me question, do we continue to see this rally in the S&P, or does this broadening out take some wind out of the sails of the mega cap stocks as, it drives other places in the market like small and mid caps?
I mean, our view is to have that rotation working, you need S&P 500 higher. So S&P, I think returns are positive. Obviously, it is underperforming. It should continue to underperform, consistent with how its kind of beta lines up. But our view is it's very hard to rotate into small cap, lower quality stocks at a time when markets are pulling back. So I actually think the rotation into small cap is almost conditional on the fact that you get S&P 500 higher.
So one thing you mentioned earlier is contingent on that Fed rate cut in December. Right now, market's pricing in a 62% chance. If you don't get it, what's the downside risk?
I mean, if you don't get it, I think that probably means you printed a really, really strong jobs report. So in that sense, I think equities are probably net still higher on that. Like, I'd much rather have a strong labor market with the Fed cuts being pushed out, which is frankly the thing we saw in the first half of this year anyway. So, like, I think for the Fed to skip, that's telling you economic data is very, very strong, and I think equities can kind of rally through that. The Uber bull case is you get, call it 150 to 200K jobs. The Fed wants to get some cuts locked in ahead of potential risks like tariffs next year, and that should push equity markets higher. So if they skip, I think it's actually for good reasons in this case.
A lot of bullishness. Either way, walking into December, that is, of course, is Stuart Kaiser of Citigroup. We're now going to take a quick check on futures here as well, because equally bullish, not as bullish though. You're watching the NASDAQ 100 futures up about 0.2%. Russell 2000 futures taking a little bit of a breather, roughly flat, and so is the S&P 500. But of course, that was after a strong November. We're going to get a look at some of the stocks moving ahead of the opening bell. Bring in Abigail Doolittle.
And beneath the surface, Sonali, we do certainly have some bigger movers than that relatively flat surface. Starting off with the shares of Tesla, this stock has been in a major rally move out of the April lows, a piece of that Trump trade. Today up nearly 2%. This says Roth MKM has upgraded shares to a buy. The analyst there saying that he believes that there's going to be a new pool of enthusiasts for Tesla vehicles. In addition, that the sunsetting credits, EV credits, could hurt the competitors. Additionally, Stifel has raised their price target to a street high of $411. Turning to the shares of Block, this stock is also higher, right now up 3.4%. Bernstein is calling it a best new idea, saying that there's lots of catalysts for the stock. Separately, Goldman Sachs has raised their price target by about 10%, more than 10%, to $102 per share, suggesting there could be more upside potential. And then finally, rounding it out, the shares of Intel, today's big stock story. We do have them up about 3.9% off the highs on the news, of course, that CEO Pat Gelsinger is stepping down, retiring, the turnaround not gaining the steam that many had hoped. The stock on those failed turnaround hopes right now down more than 50%, although I will add, Matt, at the lows, it had been down closer to 60%. So off of the lows, but nonetheless, CEO Pat Gelsinger stepping down.
All right, fascinating day for CEOs and CFOs. Abigail Doolittle, of course, the CFO of Supermicro Computer, also out, as well as the CEO of Stellantis. So a lot of shifts in the C-suite. Coming up, President Biden, speaking of shifts, taking his son Hunter off the hook. He promised he wouldn't do it. He wouldn't interfere in the U.S. judicial system. And then he does just that with a presidential pardon. That's next. This is Bloomberg. Let's get now to high interest and look at what's making headlines around the world. Tensions on the rise in Syria as Islamist rebel fighters advance south after capturing much of Aleppo again. It's the most serious challenge to President Bashar al-Assad in years since the country's civil war began over 10 years ago. Government forces, which are backed by Russia and Iran, appear to have withdrawn from some areas and are now bombing the rebels in Aleppo. In France, the government offered a last-minute budget concession to avoid being ousted from power in a no-confidence vote. French assets bounced back from some pressure on the news, but the Feta-Brie spread remains tight as investors punish the political uncertainty emanating from the country. You almost pay more to borrow from the Greeks than you do from the French. And Canada is set to beef up its border enforcement in a visible and muscular way, according to top Canadian officials. The pledge comes after Prime Minister Justin Trudeau went to Mar-a-Lago to dine with President-elect Donald Trump after Trump promised to impose a 25% tariff on imports from Canada into the U.S. due to the movement of fentanyl and unauthorized migration. Sonali?
Matt, we're going to stay on politics. We're going to talk about how President Biden announced that he's pardoning his son Hunter after previously saying that he would not use his executive powers to help him. The president wrote in a statement, quote, "I believe in the justice system, but as I have wrestled with this, I also believe raw politics has infected this process, and it led to a miscarriage of justice." For more on Hunter Biden's pardon, we are joined by Bloomberg's Julie Fine. Explain the fallout since the announcement.
Well, I think this is fallout that he obviously expected. When you do something like this, after saying several times, I'm not going to do this, and then you've got the video also of his press secretary saying over and over, he's not going to pardon his son, you have to be aware that there's going to be fallout. However, I think he made this decision that he feels, like he said, this was a miscarriage of justice. He's out in 2 months. He makes the decision when he's about to leave to go overseas, decides to do it, takes off on the trip.
Yeah, I mean, I think it's understandable as a father, right? But if you're trying to set an example for the country and be as un-Trump as possible, it doesn't make sense to be so Trump, right?
Again, I think he just hit this point that he is like, I am done. He has a party that basically said, listen, we don't want you to run for president. So at this point, he's like, I'm leaving in 2 months. I want to protect my son from what he feels is not fair. He also, by the way, this is a blanket pardon. This isn't just for
anything he's done over the past decade.
Now, there is some type of precedent. I mean, you do have to remember that President Trump did pardon his son-in-law's father. Bill Clinton, let's go way back in the day. I'm old enough to remember when he pardoned his half-brother.
And Mark Rich.
Right, so there is precedent for this. There is precedent, however...
Not good precedent, though.
Well, the difference is here, he said he wasn't going to do it. And there's plenty of evidence saying he's going to have to do it. Now Democrats who are trying to figure out, okay, what's our message? What's next for us? Who's our leader? They're all going to be answering questions about it. And I think Democrats have learned that this party has to be, we're not Donald Trump. So you can't just respond to this by saying, look at what President Trump did. You've got to come up with your own messaging on this when Democrats are just trying to come up with their message, period.
And you mentioned his son-in-law's father. We should say Charles Kushner was not only pardoned, he was recently also tapped to be the ambassador to France. I want to switch gears just a little bit here because another big story of the day, also big take of the day, tariff strategy here. Bloomberg Economics really talking about essentially a tripling of what we see over the next few years, especially when it comes to China alone. I mean, how are politicians preparing for this, especially knowing that their local regions might experience some more inflation over time? How are business leaders?
Well, first of all, I live in Texas where they really have to prepare for tariffs due to the fact of trade, coming over the border. This is how I think everybody's preparing. Let's wait and see if he really does it. Like you've got Justin Trudeau flying to Florida this weekend, going to Mar-a-Lago. Clearly he is concerned about this. You have him on the phone with Mexican President Claudia Sheinbaum. I mean, I think what they're preparing for is to see what he actually does, if this is a true threat or if this is going to happen, and definitely having these preliminary conversations, building up the relationship. Because look, I mean, the man has an enormous amount of power right now. He won all the swing states. I mean, he can say what he wants and do what he wants. Now, of course, you have a Congress as well. That's certainly going to have something to do with this. But I think the preparation really now is this going to happen? Let's try to make sure that it doesn't and prepare for it at the same time.
Did you see the picture, Matt?
Which picture?
The Trudeau picture at
yes.
Mar-a-Lago?
Yeah, I did.
Right.
By the way, I was in Florida this past weekend, a very unexpected trip. And, he pops up there on a Friday night. And from what I'm told, so unexpected that, hoteling was an issue.
David McCormick, Dina Powell, all at the table as well.
Right. So they're there. And, I mean, he's smiling and looking as happy as he can be because he needs to be smiling with President Trump to get President Trump to think, okay, we have to work together. We can't blow up these massive trade agreements, which he's saying that he's going to do. So if you're somebody like Trudeau, you're going there and saying, I want to get in early, I want to get in good, I'm going to say, maybe he'll say what he wants to say and do it quietly, but the bottom line is he knows that President Trump pays attention to the news and what's said, so that picture of him smiling may put him in a better position. A
lot of activity at the Winter White House.
Yeah, absolutely, and it makes sense, you know. It's probably a nice place to be as well. Julie, thanks very much. Julie Fine there covers politics for us, typically out of Dallas, although she is sometimes in Florida as well. We're going to continue to talk about these markets going into December. That's next. This is Bloomberg. All right, quick check on futures. You can see little movement in terms of S&P futures, NASDAQ futures, and Russell 2000 futures are higher. But it's really under the hood where we see all the action. Sonali, so many C-suite changes. Yesterday, I logged on to the Bloomberg to see that the CEO of Stellantis is stepping down. He was supposed to stay until 2026. This morning, we get a headline that Intel CEO is going to retire, replaced by interim co-CEOs. And then Supermicro replaces its CFO, but said they found no wrongdoing in an internal investigation.
Yeah, that internal investigation is a big deal. But also, it's interesting to see the stocks react so differently. Intel really getting a boost here from that announcement that Pat Gelsinger would step down immediately. Not so much for Stellantis.
Yeah, Supermicro also getting a big boost. Right now at 15%. It's obviously a much more volatile stock. But Stellantis down 7.5%, I think on concern that it just takes so long to introduce new products. And that's one of the big problems here. And Carlos Tavares was seen as, you know, the new Carlos Ghosn here, but he wasn't able to deliver. So they need to find a successor other than Johnny Elkann.
Yeah, we've written that. Also, dealers have said that he's kind of ruined the Jeep brand. Can you believe I know something about cars?
You know a lot more than you give in about cars. Jeep has been a problem, but Chrysler obviously only makes, I think, one product now, which is a minivan. Dodge has been limited now to only a couple of products. No, it's not good. They don't have anything on lots there, and that's a real problem. We're going to continue to talk about this and also tell you more about the chip story with Intel replacing Pat Gelsinger. The opening bell in less than 4 minutes' time. We're going to talk to Katrina Dudley at Franklin Templeton. This is Bloomberg. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're not seeing a lot of action in futures this morning. S&P futures now up just about 0.06%. You're seeing bigger gains in NASDAQ and Russell futures, but also not by much. It's really a story of CEO shifts today. The CEO of Stellantis, Carlos Tavares, is out. The CEO of Intel, Pat Gelsinger, is out. And over at Supermicro, a much smaller company, but they're losing their CFO, although they did an internal investigation that found no evidence of misconduct. In terms of the opening bell, I think we had Scholastic ringing the opening bell at the NASDAQ. I saw it only very briefly, and now it's gone. I didn't even see the NYSE, so maybe nobody rang the opening bell there, but we do have the markets open right now, and we're looking at the live trade, and you can see that the gains are similar to what we saw with futures. In terms of stocks to watch, Stellantis is my focus this morning, falling after the company's CEO unexpectedly stepped down or was pushed out. It was a board meeting, so we're not sure exactly how that happened, but the stock is down 7%. It leaves the car maker without leadership during a critical time for the industry, although it should be mentioned that Johnny Elkann is the chairman of the board, and he has a ton of experience, not only with Carlos, but also with Sergio before him. So I'd say they're in pretty decent hands, at least in terms of interim work. Sonali, you're watching The Gap. What's going on there?
I know that your daughters may still be too young to be hanging out in ripped jeans, but Gap here, of course, other people are buying them. You have it up now almost 5% as the market opens. It is getting a boost after JP Morgan upgraded the rating on the retailer, saying that the foundation has been set to support a consistent playbook of improved merchandising and marketing. And the big story of the day, we're taking a look at Intel. It's rising after the chipmaker announced the retirement of Pat Gelsinger as CEO. Intel now up about 3.6% as the market opens now.
All right, we'll continue to pay attention to those and those big movers on the day. I want to take a deeper dive, though, into Pat Gelsinger's retirement. It's being called retirement. We're joined now by Bloomberg Technology co-host Carolyn Hyde. Seems a little abrupt, Carolyn, for a retirement. And they didn't even have a replacement ready, just interim co-CEOs. What's the story here?
And they seem to be elevating Michelle Johnson Holthaus, who is known as MJ, into a CEO of product role at the same time as giving her this interim role alongside the CFO. Whether or not it's abrupt in terms of a decision to step down from Pat Gelsinger, the slow burn on Intel has not been abrupt. We're down 60%, let's call it, in terms of share price this year. Pat had a particularly painful set of numbers in August that really sent record share drop on the back of ever more evidence that this company is falling behind. Just think, 60% down in his tenure for Intel, whereas Nvidia's up 800% in his tenure since 2021. And even AMD has done particularly well since he took over in 2021. So this has been a painful leadership trajectory as he's tried to reorientate, get back into the fabrication side of the business, which of course they had to put on ice when they were building out the manufacturing area in Europe in particular.
And I'm sure investors are very soon going to become much more antsy to actually get that more permanent replacement. In the meantime, what do we know about the interim co-CEOs? Matt was joking, always a good idea to put two people in charge.
It's never a good idea, and yet boards do it all the time.
And we don't know how much this is going to be on an interim basis with these two internal candidates, or how much they then go to look externally. Remember, Pat Gelsinger himself was long-term Intel. 1980s he came on. He was like key to the fabrication of certain microprocessors and building of them at Intel. He then became the CTO, left to VMware, which was, of course, combined from EMC. Then he came back again. When you're looking at MJ and when you're looking at David, the CFO, look, these are two long-term executives. These are people who perhaps, when they're giving MJ in particular a upgraded role to the head of product, and within the statement they put out today, they say the product needs to be back at the heart of what they're doing within the business. Maybe that's trying to signal something about her long-term trajectory here. But more broadly, I think it is trying to get their arms around what the strategy is. Is this a company that they're going to start breaking apart and selling off to others? Now, remember, we've had reports that ARM, Qualcomm have been interested in this company. We already had a big returnaround proposition coming from Pat saying that the foundry business will be spun off. It will ensure that they'll keep it but different operating board more broadly. They want to be manufacturing and designing. They need to keep up with the likes of TSMC. They need to get Gaudi in there. Remember, this is the AI accelerator part of the business that is likely to miss $500 million target for this year. When Nvidia's bringing in $100 billion a year, when AMD is bringing in $5 billion a year, this is the future of chip making. They need to start showing some, precision there. And MJ, Michelle Johnston in particular, is the person who is leading the AI push.
Yeah, sounds like the downfall of an American icon kind of wrapped up here. Carolyn Hyde, thanks so much for joining us. She is the co-host of Bloomberg Technology. You can see her show at 11 a.m., and I'm pretty sure they'll probably focus on this issue as well. Right now, let's talk broader markets with Katrina Dudley, Franklin Templeton Public Markets Senior Investment Strategist. Katrina, a lot of CEO shifts today, but not a lot of movement on the index level. Do you have any thoughts, first of all, on American business icons that are flailing?
I think it's so interesting to sit here and for us to say they failed and they're flailing and everything, and to kind of judge from the outside. I think realistically, you need to be an insider to get that real look into.
Well, if you're an investor, you definitely feel the pain, whether or not you know what's going on inside or not.
Exactly.
Right? Your stock's down half over the last 3 years, and the market has tripled.
Exactly. But the thing about CEO changes is they can be a signal of, yes, there was bad things that happened, and that often is the accelerant that causes the change, and it reinvigorates people's desire to continue to change, because change happens when people take action. And so I actually look at some of these CEO changes as a positive thing. However, if you have a look back, we have seen over decades a number of companies in the industrial space where you've had a CEO change. You've had even some really well-known brand name CEOs come into a space, and the stock still takes another leg down while they assess the company, they assess what's wrong, and they put in place their plan. And investors during that kind of information vacuum, they don't have anything to kind of sink their teeth into. And so I would expect that you could see in certain of these situations further weakness.
Something I find really interesting today is not only do you see Intel up almost 3%, you actually see most of the Philadelphia Semiconductor Index up, and you see Taiwan Semiconductor ADRs and Marvell up even more. And you think about the posturing that the U.S. has to the chips industry and the way that they're looking to tighten curbs on how China accesses AI memory chips. What does this mean for the industry, particularly in the United States? With the big AI bet that's going on, do you double down?
So isn't it interesting? We've been talking about Trump and tariffs and what's going to happen. And it's actually the Biden administration in their final days that are doing these actions in terms of further curbs on China and further protection of the U.S.'s intellectual property. And I think that that's the key message I'm taking away from this, is that the U.S. is finally kind of backing with its might and saying, you cannot take. And that's a very positive message. Why is it so positive? Because it sends a signal to people that we will protect assets that were developed here by our companies, and we will enforce the rules and the rule of law. So I think as you look at AI and you look at companies, AI is such a long-term, investment. It's a lot of upfront capital. You're getting a very clear message that we will protect that investment and your right to earn a return on that investment. And that's what we want to see as investors in these companies. So it's positive.
Does that AI optimism, or at least expectation of massive capital expenditures, boost your outlook for the broader market? I mean,
yeah, it's interesting. AI, from our perspective, has really interestingly three aspects to it. The first is as we look at companies and the productivity. So you look at Bloomberg, you look at Bloomberg Automation, for example, and the productivity they're generating. The second, as we look at investing in companies, you mentioned a number of the beneficiaries. NVIDIA is obviously the poster child for that, but we have it from investee companies where we put our capital. And then finally, from our point of view as a company, we have AI opportunities in terms of making our sales force, meeting our clients' needs and becoming more efficient. So the AI story to me is not this one-dimensional investment. It has the CapEx side, it has the productivity side, it has the investee side. So there's just so many dimensions to it, which means there's a lot of opportunity.
I'm glad you mentioned Bloomberg Automation. The other day, Ken Griffin asked me what I use it for, and I love somebody else, a robot, reading my 13 Fs for me, is what I said.
Good point.
And, one thing I'm really obsessed about, you mentioned tariff strategy. You have Bloomberg Economics predicting that the tariffs will be implementing in 3 waves. It'll start in the summer of next year, and that it would be a tripling of levies on China by the end of 2026, smaller hike on the rest of the world. The bigger issue, I think, is imports and exports dropping to 18% of the global total from 21%. That is meaningful.
Yes.
And what does that mean in terms of American economic growth?
I think anyone who can put a definitive date on when these tariffs are going to be implemented deserves a pat on the back, because I think that we're looking at the information we're receiving. There's so much uncertainty here. We're not sure if it's just posturing. We now have Bessent, who's in his role. We think he's likely to temper some of these because of the economic impact. If I have a look, yes, there is going to be some level of negative impact in terms of the consumer, the pressure. But companies have got time. You're talking end of 2026. That is over 2 years for companies to prepare. Our companies are nimble, our companies are quick, and they're adaptive. So I would actually take the other side here. I would actually say, yes, I can make you the negative case, but I'm going to bet on America, and I'm going to bet on the fact that we're going to adapt.
A lot of bullishness this year.
I like it.
Yeah.
Katrina, happy December. Thanks so much for joining us. Katrina Dudley there of Franklin Templeton. Coming up, Stellantis shares are under pressure after the CEO's surprise resignation. More on the auto sector next. There's a lot going on, including Volkswagen strikes in Germany. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on stocks. Right now, you can see that the gains are minimal at the index level, just about 0.1% on the S&P. The NASDAQ doing far better, up about 0.6% 0.1% as we see gains in stocks like Intel and Supermicro Computer shifting out their leadership. In terms of the Russell 2000, you do see a little bit of a drop here, about 0.1%. It's time for our top calls now. Some of the analyst action in focus this morning. And first up is Gap, getting upgraded to a buy at JP Morgan after the firm met with the company's CEO and CFO. The analyst sees Gap at an inflection point that will support sales growth. And next up, Morgan Stanley says it is treading more carefully on cybersecurity stocks. The firm is downgrading SentinelOne, saying it's no longer a buy. The analyst says the incoming Trump administration could propose significant budget cuts, and that could be a major headwind to cybersecurity. Finally, Toast is getting downgraded by Goldman. The firm says the restaurant software company is no longer a buy, citing elevated valuations and limited visibility. And Stellantis has been a focus this morning. The shares under pressure after CEO Carlos Tavares stepped down. He had a dispute apparently with the board over how to reverse the car maker's weakening sales and stock slump. For more, Bloomberg's Oliver Crook joins us out of Berlin. And Oliver, this all came to light after a board meeting yesterday. What exactly happened?
Yeah, exactly, Matt. I mean, listen, this really began, I think, back in September when Stellantis put out that profit warning, which really caught the market off guard, and I would say really has been sort of staggering forward ever since that happened. At the time, Tavares basically tried to quash any sort of discussions around the fact that they might be time to replace him. He said he was certainly going to see out his contract until the beginning of 2026. And at the time, he said a management massive shakeup. He replaced the CFO, the COO, the COO in North America, the heads of Maserati, as well as Alfa Romeo, to really quash any discussion about him stepping out early. And he had basically the unanimous support of the board, and that changed over the weekend on Sunday with this sort of sudden bowing out, basically, and walking away from the car maker. And Matt, as you know, this is pretty huge for the European car sector. Tavares has been there since the inception, the beginning of Stellantis. The combination between PSA, Peugeot Citroën, and FCA, Fiat Chrysler back in 2021, and really a legend within this sort of sector. Really, he had been focusing on the cost cuts across the board, cutting very deeply. That is part of the sort of criticism that he's got from a number of the dealers, but also the unions, that maybe he cut a little too far, and some of that sort of being evident in some of the quality controls and some of the cars that we're seeing out of the United States, particularly.
Quality control, Ollie, and also brand damage. That was the criticism you got from dealers here in the United States: Jeep, Dodge, Ram, and Chrysler. And so if you look to a potential new CEO, reporting that you might not have one until the first half of next year at some point, how big of a hurdle is there to turn those brands around? How long would it take?
Yeah, I mean, listen, this is the question for not just Stellantis. This is a question for the auto sector in general in the United States and in Europe. And this is really not the time to be without a leader, I think, in the European automotive sector, any automotive sector, right? And Stellantis really had been doing comparatively really quite well compared to a lot of the European brands, particularly earlier in this year. And really that has all basically evaporated. The stock is down 45%. It is now the worst performer of all the European auto sector going into closing out this year. And again, this is really not the moment to be without a sort of clear vision for what you're going to do with this brand and the many, many brands within the portfolio. This is part of the issue that we're having across the industry. There are a ton of brands. They're getting more and more crowded because you have more and more Chinese automakers, particularly in EVs, outcompeting these European brands. And the answer is no one yet really has an answer yet, but everybody is trying, and everybody increasingly is trying to cut more and more costs. I think part of the concern with Stellantis is they've already cut so much of the cost that that bullet might have already been fired.
Yeah, I'm looking at the websites now, right? Dodge, they still list the 2023 Challenger and Charger as products. They don't even make them anymore. In terms of Jeep, they have a Jeep Wrangler that costs over $100,000. That's pretty ridiculous. Ram Trucks doesn't even make a V8. I mean, they just seem to have given up. They need someone who can bring back some product.
And this is part of the criticism, right, is that there just is not enough product. There is a sort of endless number of brands, but there are not these new models that are coming forward to market. And that has been a big complaint from the dealers. It has been a big complaint from a lot of the consumers. Not everybody has the good taste, Matt Miller, to buy a Dodge Challenger V8, though perhaps they would be benefited from doing so.
Yeah, I highly recommend it. Go out and get a used one. Oliver Crook in Berlin, thanks very much for joining us. I want to quickly bring you some breaking news on France. The Prime Minister there, Michel Barnier used a constitutional tool to push through parts of his unpopular budget bill without a parliamentary vote, raising the prospect lawmakers could dissolve his government within a matter of days. So the disaster continues there. Coming up, JP Morgan rejecting a popular Wall Street trend. We'll take a look at why in today's Wall Street Beat. I'll give you a hint. It's ESG and it's unpopular.
Energy transition.
Is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Quick look at what's going on with stocks. Just about 20 minutes into the trading session, you can see the S&P 500 gaining 0.1%. The NASDAQ up a lot more as Intel and Supermicro gain after ousting some of their executives. Russell 2000 stocks, though, down about 1/3%.
But after a very strong November, as we've been talking about, but we're going to switch gears, Matt. We're going to go to the Wall Street Beat. Today, we're looking at why JP Morgan is rejecting a new Wall Street trend. For more, we are joined by Bloomberg's Alastair Marsh, and you make this point in the story. JP Morgan is really bucking the trend here in transition finance. This is all, when it comes down to the energy transition. But Apollo, a big client, sees a $50 trillion opportunity over the next couple of decades. This is why other banks have been getting involved. Do you think other banks will start to go the route of JP Morgan, given the returns you've seen in renewable?
Hi, well, good morning. So what JP Morgan is actually saying is that they're not rejecting the idea of an energy transition. They sort of support or endorse the thesis that there is money to be made from financing companies that are decarbonizing. But what they're saying is that they themselves are not going to create some sort of framework. The whole ESG establishment so far, the whole architecture is built around frameworks and taxonomies, and is this a green asset, is this a brown asset? And they're saying that in some ways, who cares about that? What's really important is, are we financing, not just do we have transition finance, but are we financing the transition of real economy companies? And so that's sort of their focus. It's not that they deny there's an opportunity, as Apollo have said, it's more that they think we don't need any more taxonomies or frameworks. We're kind of taxonomied out. Leave us alone with the box to tick. We just need to get to the real action of financing kind of corporates who want to decarbonize. That's what they're saying.
I mean, it seems like the opportunity is one to lose money, Alastair. I look at, the S&P Global Clean Energy Index that you highlight in the story, and it's just gone down. I love the Linda French comments about we don't care about taxonomies. It doesn't matter what you label it, green or ESG or whatever. We're only going to invest in something that's financially viable.
Exactly. I mean, the high point of ESG was a couple of years ago when everyone was committing to net zero, was saying we're ready. But then what happened was just a few months after that, you had Putin invade Ukraine, you had energy prices go through the roof, and you had all these fossil fuel companies that banks and investors had talked about withdrawing from. Those were suddenly very profitable clients, and that totally changed the calculus on the energy transition and how banks should be involved in it. And you're right, the clean energy companies and clean energy stocks have been obliterated in the last sort of 2 years. And that has really pulled the rug out from underneath all of those who are championing this notion of we need to have an energy transition. Banks are pushing back and saying, yeah, fine, we'll endorse it, we'll support it, but only insofar as it delivers returns for our shareholders. Let's not forget we are...
We have just a couple, 30 seconds or so left here. There's an amazing chart in this story as well that shows just how much power grids have been an increasing part of the story in the last 3 years. Is this all AI? Has the narrative changed around the energy transition?
Well, the AI really complicates the energy transition because the energy usage, as you know and have spoken about many times, is enormous, is vast. But at the same time, the companies that are really building out these data centers, the Microsoft and so on, are the guys that are actually the most committed and have done the most when it comes to building out and sourcing renewable power. So it's sort of a double-edged sword, and the jury's out as to whether AI will be beneficial to the energy transition or not yet. Certainly, it's creating a lot of money flow towards renewables, but there may come a point where we're having to run energy centers on fossil fuels too.
Well, it is a fantastic story, Alistair, and I love the visuals in it as well. Highly recommend that people check it out on Bloomberg.com or on the Bloomberg terminal. Alistair Marsh there penned the story. JP Morgan rejects transition finance trend gripping Wall Street. Coming up, we're going to talk to Liz Ann Sonders from Charles Schwab. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today.
Let's get a check on what's going on in the markets right now. We're looking at gains, slight gains on the S&P 500, much bigger gains on the NASDAQ as Intel and Supermicro Computer kick out some executives. The 10-year yield right now up almost 7 basis points to 4.23. We're getting ISM manufacturing data right now that's a little bit better than had been expected at 48.4. We were looking for 47.5. Both of those numbers better than we saw last month. Construction spending also a little bit better than expected. Prices paid not quite as high as expected. To help us interpret all of this data, let's get over to Bloomberg's Michael McKee. He joins us here on the desk. Mike, what do we know? What can we tell from these data points?
Well, things are a little bit better in manufacturing. They're still not expanding. We're at 48.4. That's from 46.5. But as you mentioned, it is better than anticipated. The production number is still down, but up just a little at 46.8. New orders, though, come in above 50, 50.4. So there is some hope for the future in this. And then the employment number, which everybody's going to try to plug into their models for Friday, 48.1 from 44.4. So that's a significant increase, even if they're not adding a lot of bodies. And then, of course, everybody's watching prices paid, 50.3 down from 54.8. So these numbers today would fall into the category of the Fed can probably go ahead and cut rates in December. It's certainly not going to be anything totally decisive, but it is a little bit better than expected in both the employment and prices number. However, the headline number still below 50 for the 24th month out of the last 25.
It's interesting. Market pricing not changing a heck of a lot. You have now a 64% chance nearly, apparently, according to WIRP on the terminal, for that December rate cut. The big moment of the week is still at the end of the week, as you alluded to, with the jobs number. How does that picture start to change things?
Well, once we go through the week, we'll get ADP, we'll get the ISM services employment numbers, and we'll get the jobless claims numbers, and all that gets folded into what people are expecting. But right now, the bet is we get a rebound from the dismal numbers in October with the hurricanes and strikes behind us. The only question is, how high does it go? And then how much can you attribute to a rebound effect? If it got really strong, then that would be something for the Fed to be concerned about. But probably anything up to 200,000 or a little more is going to just be looked over by the markets.
I play with this new eCan function that you turned me on to in terms of like AI extrapolating various phrases from, I guess, earnings calls. I put in reshoring, right, to see how much talk there is of bringing manufacturing back to the U.S. And I'm surprised to see that it actually has turned lower in the past few quarters. So there's not as much talk about reshoring going into this next Trump administration as there was at the beginning of the last Trump administration.
Well, I think people have basically figured out what they think Trump is going to do and what's really going to matter. But remember, over the period of the Trump administration and the Biden administration, we've had a lot of reshoring. Now, it's not as much reshoring as friendshoring, but a lot of companies have moved their supply chains closer to the U.S., either Canada, Mexico, or to friendly countries in Europe, so that they don't have as much of a supply chain constraint as they had when the first Trump tariffs came.
All right, so they've already kind of done it. I just recommend any clients out there with a terminal, you got to type in ECAN GO. In the top box, plug in AI-powered S&P 500 topics and play around with this function because it's pretty incredible, the depth of the data. All right, Mike McKee, thank you very much for that. Let's get over to hedge funds right now. They sold U.S. stocks last week despite gains in the S&P 500. Bloomberg's Natalia Knijevic is here with more on their positioning. Natalia?
Matt, and degrossing on Monday and Tuesday, specifically last week, was the largest since July. Hedge funds sold U.S. single stocks. We saw the largest actually selling across financials, which is quite a reversal after the U.S. presidential election. Now, technology stocks, infotech, are still under pressure. Hedge funds are not buying them. So this is your defensive stocks. Also, they were sold by hedge funds last week. And in terms of inflows, this is interesting, energy and industrials. With energy, hedge funds bought energy stocks despite oil was 3% lower last week. But this week, probably energy stocks will get a boost from rising oil prices, at least that's what we see in the price action today. So we do see some hesitation in terms of hedge funds, but they're still on a year-to-date basis, they are still under position. So probably in December, they will buy more stocks.
What do the fund flows tell us about the potential returns for the S&P 500?
Right, so it's the end of the year, and in December, it's always good to look at seasonality. So this chart, this is from Goldman Sachs' Scott Robner. He analyzed the data going back to 1928, and it tells us that the first 2 weeks of January, this is the first bar, and the last 2 weeks of December are supposed to be the best 4-year period for the S&P 500. He expects the S&P can move up by 2.6%. And there are a few reasons behind that for this year specifically. So we do see that earnings are still good. Inflows into U.S. stocks are really, really high. And on top of that, the options market is now telling us that dealers are long gamma. It approached a level above $8 billion. Basically what it means, if traders are long gamma and if market participants are selling stocks, market dealers have to buy the dip to maintain that neutral position. Basically, it prevents us from major sell-offs. So at least for now, guys, it looks like that there's nothing that can stop rally in the U.S. stocks market, at least until the year end.
Natalia, we thank you so very much. Of course, that is Bloomberg's Natalia Knijevic. Joining us now, Liz Ann Sonders, Charles Schwab, Chief Investment Strategist. You know, Liz Ann, when we think about what we've heard all morning from guest after guest, there has been a fair amount of bullishness, a lot left, even after you've seen the most recent rally. Do you feel that way?
You know, I actually think the sentiment picture is somewhat mixed. If you look at attitudinal measures of sentiment, the most popular of which is probably American Association of Individual Investors, AAII. And they do a weekly survey of their tens of thousands of members. And actually, the percentage of bears now outnumbers the percentage of bulls by a small margin. But then you look at things like equity ETF flows, particularly in some of the hotter areas like tech, and those have been quite strong. So you have this disconnect between what investors are saying in those attitudinal surveys and what they're doing measured by things like fund flows. So I don't think we have an extreme one direction or another. Sentiment is never a perfect contrarian indicator. It's not a market timing tool. But when you get an extreme that is corroborated across both attitudinal and behavioral measures, that's a little bit more of a signal. And I'd say we have kind of mixed signals in this environment.
Does the rotation, Liz Ann, kind of limit the gains that we could see in the benchmark index? I mean, we're not going to see maybe the S&P advance 5% if a lot of investors are taking S&P profits and putting them into, the Russell 2000, which was up 11% last month.
Well, I think we can continue to have rotation under the surface that maybe doesn't take the cap-weighted indexes down with it. That was the story of the first half of the year, where by mid-July you're screaming at all-time highs in both the S&P and the NASDAQ, but then you started this weakness under the surface. And even before then, if you look at just the average member maximum drawdown in an index like the NASDAQ is back at all-time highs, yet the average member maximum drawdown is negative 47% this year. So you can see a lot of churn and rotation. It's kind of like the old Michael Caine phrase about the duck, smooth on the surface and paddling like the Dickens underneath. And I think that could continue. And some of these sector rotations I would expect to be quite fierce, but not necessarily consistent. Today is a perfect example of money moving back into what we think of as the growth trio: tech and communication services and consumer discretionary. We've seen it away from the Mag 7. We've seen it into financials, into industrials. And I think that swift rotation under the surface is likely to continue. But as it's a rotation and you still have decent performance up the cap spectrum, that keeps the cap-weighted indexes looking relatively healthy, but it sort of masks some of that churn under the surface. And I think that's going to carry at least into the first part of 2025.
Lizanne, when I think about the tail wagging the dog to this market, I want to ask about the bond market. Because, yes, fine, we're heading into a big week of economic data where you have yields on the rise today, but you take a look at the 10-year. Over the past month, you almost hit 4.5%, and now you're back closer to 4.2%. And where do you think ultimately this goes? I mean, how much fuel could potentially lower yields than initially expected really feed the market?
I think in terms of moves up and down in, say, the 10-year Treasury yield and impact on the equity market, I think it's a function of what is driving yields. When yields become quite connected to the inflation story, both on the upside and the downside, that tends to mean you're in a backdrop of an inverse correlation between bond yields and stock prices, meaning higher yields on the back of higher inflation, negative for the equity market. But when yields are connected more to the growth outlook, that tends to be a more positive backdrop for equities. If you look at, say, 1-year correlation between bond yields and equities, we're still in that inverse territory. But if you shorten that to the past few months, you're slightly in positive territory. And that's because bond yield moves have been a bit more connected to the growth side of the equation, not the inflation side of the equation. So I think it's the background behind why bond yields are doing what they're doing that drives whether equities perform better or worse in either direction.
Lizanne, investors seem very excited about Trump tax cuts and deregulation, but they, I guess, kind of push aside worries about tariffs and deportations. Why do we only consider the good, potential good, and not the potential bad?
I think we should consider everything, and I think that's part of the reason why we continue to have cross currents. Taken at face value, if you look at the combined effects of deportations and higher tariffs, it's hard to argue against that being somewhat stagflationary, upward pressure on inflation, lower pressure on growth. You're right, though, if corporate taxes are cut, you get a laxer regulatory environment, all else equal. That's better for corporate side of America, better for corporate profits. We are an importing nation, so any improvement that you see there in areas like lower taxes actually can work in contrast to the effect on things like the trade deficit of higher tariffs and more deportation. So I think we're all, there's so many mixed signals heading into the start of the administration. I think it's really hard to put a finger on what this means for the inflation backdrop, what it means for the growth backdrop. And it's part of the reason, notwithstanding the better ISM news, and we actually think and have posited that we were going to start to see an easing in some of these bifurcations with maybe manufacturing starting to stabilize and actually catching back up to what has been stronger services backdrop. But we have seen things like capital spending intentions stay fairly muted. And I think that's in large part due to the massive uncertainty with regard to what was on the campaign platform and what actually will become policy post-January.
Heading into the end of the year, at this juncture, what would be your favorite trade?
I think you want to stay factor focused, and heading into the beginning of next year, I think the shift that's going to be important from a factor standpoint is a shift from level mattering to rate of change mattering. So if you look at things like interest coverage, strength of the balance sheet, free cash flow, profitability trends, those were successful in level terms, good versus bad. I think it's better versus worse that matters more in those factor-based screening methodologies, looking for companies that have improving profitability, that have improving interest coverage, particularly if the Fed continues in the easing mode. So I think it's somewhat subtle, but I think that's an important shift to consider as we head into the end of the year, into the beginning of next year.
Liz Ann, great to have you on the program. Thanks so much for joining us. Liz Ann Sonders there of Charles Schwab. Coming up, a change at the top of Intel as the company's turnaround flounders. This is Bloomberg. Let's get out of high interest to look at what's making headlines around the world. The far-right National Rally Party of Marine Le Pen is announcing it will back a motion to topple the French government. This after Prime Minister Michel Barnier failed to agree to all of its demands on next year's budget. The National Rally's parliamentary group wrote on X that the government deserves to be dissolved. The euro dropped to a session low, hitting 104 against the dollar. And BlackRock is nearing a deal to buy private credit manager HPS Investment Partners. Sources tell Bloomberg that the agreement could be announced as early as this week, valuing HPS at $12 billion or more. The deal would give BlackRock, which already manages $11.5 trillion, more than $500 billion of alternative assets. The CEO, Larry Fink, has been moving aggressively to expand the firm's private market offering. De Beers is cutting diamond prices by over 10% across the board as the world's largest producer abandons attempts to put a floor under the slumping market. The diamond industry has been anything but sparkling as it contends with one of its deepest and most prolonged declines in decades, thanks in part to a collapse in the Chinese luxury market. Sonali?
Meanwhile, Matt, Intel CEO Pat Gelsinger announcing that he will leave his post after Intel's comeback had sputtered and it fell further behind rivals, especially throughout the course of his tenure. Mandeep Singh of Bloomberg Intelligence has more details. When we think about the uncertainty ahead, because he's stepping down imminently, you have two interim co-CEOs. Who's leading the charge here?
I mean, the CFO clearly knows how the individual segments are doing, and in this case, the foundry business has a negative gross margin. The core PC and data center business, at least, the gross margins are still stable around 40%. So the problem area has always been foundry, at least since the time Pat Gelsinger has taken over, and he brought in the CFO from Micron to become the CFO of Intel. So I think when you look at the sum of the parts, you have to ask yourself, what is it that Intel could do right away with the new CEO coming in to change the sentiment? And I think the divestiture of the foundry business seems to be the most visible thing. They already kind of spun off Mobileye, but then this would be a big step in terms of improving the margin profile of the business.
So they'd be left with a unit that designs chips and then sends those designs, I guess,
to its own foundry.
To its own foundry, or
which would be a separate.
Or business. When it's a separate unit, maybe they send them to TSMC instead, right?
Yeah.
Then they've got the foundry unit that doesn't make chips for anyone, right?
Well, so that's where actually Amazon has announced its intention to use Intel Foundry. The problem is right now for anybody to use Intel, you have to ask yourself, is Intel going to compete with you? Yes. Why wouldn't NVIDIA use an Intel Foundry? Because Intel will compete with them. But if it's an independent business, spun out from the Intel entity, like AMD did with Global Foundries.
With tens of billions of support from the U.S. government.
Exactly.
Yeah.
Then, and actually, an NVIDIA may not mind using that foundry, which is a separate entity from Intel. So it does make a lot of sense, at least from a strategic perspective, to spin that out.
How much more capital would it need in that scenario?
Well, so, I mean, they are, right now, Intel has a capex of $25 billion. Compare that to TSMC over $40 billion. But $25 billion is why Intel is burning $15 billion a year. So once you spin out that foundry business, Intel will be cash flow positive. And look at the Intel employee base. They have 130,000 employees still, even though they've done 3 cost cuts. NVIDIA has 30,000 employees, and NVIDIA has more revenues than Intel now. So clearly, there's a lot in terms of revenue per employee that Intel has to catch up on. But the foundry side is where all the sunk costs are. And look, you need manufacturing. So it's not as if Intel doesn't need manufacturing. Does it need to be part of the same entity? And the answer is probably no.
Mandeep, we thank you so much for your analysis. Of course, this is hot off the press just this morning. Mandeep Singh of Bloomberg Intelligence. And still ahead, Starbucks just opened a cafe in South Korea with views of the Hermit Kingdom. We're going to give you details up next. This is Bloomberg. And it's time now for Social Climbers. The company's making waves this morning. First up, Amazon founder Jeff Bezos throwing his weight behind a startup that has ambitions of taking on NVIDIA in the AI market. Bezos is part of a $700 million funding round for Tencent. The startup is now valued at $2.6 billion. The funding round also included Samsung and LG Electronics. Next, Southwest Airlines says it could end its cabin service, including snacks and beverages, earlier on its flights to keep flyers and crews safe from potential turbulence injuries. Over one-third of all U.S. airline incidents between 2009 and 2018 were because of turbulence, according to the NTSB. And finally, a brew with a view. Starbucks opening up a new cafe near Gimpo, South Korea, where patrons can enjoy their dark roast while getting a glimpse of life inside North Korea. Visitors must pass through a military checkpoint on the way to a Starbucks cafe, Matt.
Interesting stuff. Okay, I don't know if I'd go that far to get a cup of coffee. Let's get a check on the markets right now in terms of the major indexes. The S&P 500 up about 0.2%. The NASDAQ doing much better as Intel and Supermicro among the many gainers on the tech-heavy index. And then the 10-year yield right now up about 6 basis points to 4.23. When we come back, we're going to talk about a new market for luxury travelers, a class pass of sorts for resort visitors. We're going to talk to Michael Wolff of ResortPass next, as we just passed the busiest weekend for travel in world history. Will it continue into the end of the year and 2025? This is Bloomberg. Michael Wolff likes to make markets where there were none before. He previously ran global operations for ClassPass, a company that allows fitness buffs to hit up multiple gyms with one subscription. His latest job is running ResortPass, an online marketplace that allows users to buy day passes to the swimming pools and spas at hotels and resorts around the world without having to spend the night. He's here with us on set now after the busiest travel weekend in world history. And I guess tomorrow is Travel Tuesday, Michael, right? So how's business looking ahead of that?
It's looking great. I think Travel Tuesday is actually going to be the highlight of the entire Cyber Week this year, because people are focused on deals, but they're also focused on experiences. And I think unlike the last few years where experiences were about longer duration, so coming out of the pandemic, revenge travel, people wanting to kind of chuck things off their bucket list, now people want the shorter escapes and more frequently. So that's what we're seeing a lot, and we're seeing our numbers are up 50% year over year.
So ClassPass was obviously massively successful, and it makes a ton of sense for someone who wants to do different Pilates or whatever, at different places all the time. Is ResortPass a different model? Because you can, I notice on the website, go and buy just individual days. You don't have to join for the year.
Exactly. So ResortPass is not a subscription, so we enable day access to hospitality. So you're not staying overnight at the hotel, but you can use the amenities, things like pools, cabanas, spa, fitness, wellness, even the rooms just for the day. And the basic premise is that people are traveling and walking by hotels and driving by their hotels in their neighborhood all the time, and they assume that's for a traveler. But 97% of travelers visit a hotel once in their lifetime, whereas we're living and working by hotels all the time, so you can have a more ongoing relationship with the hotels.
the other thing that happens when you go to your website, the first thing you see is the idea of saving $50 this holiday season. How budget conscious is the consumer right now, especially if they're not, as you say, doing that revenge travel? They want to stay a little more local.
Yeah, I think people are looking for value and they're looking for a deal. And this is a way that people can access luxury hospitality in a more accessible way, and they can also do it more frequently. So 85% of people we speak to feel recharged after just a single day off. And that's what we enable them, is to have that single day off throughout the year rather than just a single long vacation.
I need like 5 days off.
We just had them.
Yeah, well, you know, it's the holiday season. What does traffic look like for you right now? What can you tell us?
Yeah, so like I said, you know, over the weekend, traffic was up 50% year over year, and that's before Travel Tuesday, where our business really peaks.
At the end of the year.
Exactly. So we're expecting kind of quite a busy holiday season. And we both have this local use case, but we also have a traveler use case. So people do use the product when they're traveling. They might be staying at an Airbnb or a Vrbo, and they want the hotel amenities to complement the stay within that. So they like the privacy, they like the more space available with the short-term rental, but they want that luxury hotel amenity as well.
Right. I mean, I was talking about in the meeting the fact that I would go, say, to Cabo and rent a house and then use a one-day resort pass to get in so my kids could do the water parks or whatever. But you're saying a lot of people are doing it locally as well. I know you just started working, for example, with the Plaza right down the street from here. So I could go on your website and get a day at the Plaza and hang out in the Oak Room and maybe take a nap in one of the
Exactly,
bedrooms?
or maybe use the luxury spa there. It's one of the top spas in the city. So yeah, it's really about this local experience. We're all walking by our hotels in our neighborhood all the time, and yet we assume that's not for us. It's just for the traveler. But again, the traveler doesn't come there that often. So it makes much more sense for the local to have a more ongoing way, an ongoing relationship with the local hospitality in the market.
What are the most popular products? What are the ones that people use the most in terms of, you know, which resort or which city do you find the most popular?
Yeah, so pools is definitely popular. People just enjoy being by a pool. We did a survey. 51% of people just enjoy eating by a pool more than if they weren't by a pool. But cabanas as well is a really popular, one of our fastest growing products, because people love the opportunity to kind of have a day of recharge with their friends or family, again, you know, maybe by a pool or in kind of a spa setting. Spa as well is one of our fastest growing categories. There's all these incredible hotel spas that people don't even know are accessible to outside guests, and we're enabling that. And finally, even the rooms for the day in this moment of recharge. So again, you know, you don't have to go home, you know, all the way back home. You can just have a moment of recharge right at a local hotel.
He's making a nod.
It's a pitch to you, Sonali. You don't have to. You can take a nap.
Anyways, you know, the other aspect of this is this has been an unseasonably warm winter already, late fall. What has that meant in terms of where people are choosing to go?
Yeah, so we work all over the country, and we actually are in 30 different countries as well, in addition to the United States. We see that there's some markets that are a little bit more seasonal, but because of the warm weather, we have more markets that are kind of extending their season well into November or even December than we've seen in years past. But Miami is a very large market for us, Phoenix, Hawaii, LA, New York. So it's such a range of markets, and really the product works everywhere, and that's kind of what's so beautiful about it.
What are your plans? Do you think this is a company that could go public, or are you otherwise looking for funding to grow?
You know, right now we're just focused on building. We're truly creating an entirely new category that has never existed, and that's really fun. That's kind of what I've done my entire career. So we don't have any imminent IPO plans. I'll be sure to come back on this show to tell you before anyone else. But for right now, we're really focused on building the category.
Yeah, we do want to know if you're going to IPO, when you're going to IPO, what that'll look like. Michael, great to spend some time with you. Thanks so much for visiting us here at 731 Lex. Michael Wolf, they're the CEO of ResortPass. It does make sense, Sonali, that you have now moved out of Manhattan. I hope I'm not sharing too much information, but
very private person.
You have so much to do in the city at night. You need a place to nap. So now you could just do it at the Plaza.
I was wondering where people did this. I know that it happens. You want to hear a crazy story that I heard that bankers are doing? The ones that have moved to Miami are keeping suits in different hotels across the city because they're coming back here so much.
Yeah.
Maybe they can resort
That makes
pass.
sense. You need a place to keep a car. You need a place to keep a suit. Let's get a check on what's going on in the markets right now. Bloomberg's Abigail Dudley standing by. Abby, what do you see?
We're looking at a tiny gain for the S&P 500 right now, about 0.2%. This after the S&P 500 managed to put up another gain last week after the gain before, and then there was a decline before that in the week of the election again. So basically that Trump trade out of the election still in effect, 3 out of 4 up weeks into a small gain. You can see yields higher a little bit. That has to do with the dollar dollar being up about 0.7%. And that in turn has to do with the euro being down 1%. This, of course, after Marine Le Pen is basically saying that she wants to try to topple the current government after they went forward and passed a budget without her approval, essentially. So she is backing a no confidence vote, her far right party. And then oil, you can see up about 0.8%. So that's a big cross asset view. After the big rally that we've had, because it's not just the last 3 out of 4 weeks, Sonali, it is also over the last basically 11 months, the S&P 500 up more than 25%. In the past, when we've seen the S&P 500 up that much, we've had gains of various amounts, basically more than 1%. So this history suggests that very likely for 2024, it will also be a gain into the end of the year. Today, some of the gainers that we're taking a look at, there are a few of them, some big gainers, despite the fact that we have that just small gain on the surface. We have the shares of Supermicro Computer rallying on the news that their internal investigation found no wrongdoing from an accounting standpoint. They also have booted the CFO. This stock now up 120% over just the last couple of weeks on the idea that they are going to try to stay on the NASDAQ, keep that listing. Block is the best new idea at Bernstein, shares rallying. We have Marvell higher as they've expanded their AWS Pact for AI in the cloud, up very nicely, up nearly 3%. And then finally, of course, Intel staying higher, up about 4% off the highs, but nonetheless, Pat Gelsinger, the CEO who's exiting, well, investors seem to be cheering that on the idea that a new CEO, once the board finds one, maybe will, in fact, bring around a turnaround. That stock down about 50%, Sonali, on the year.
And gains over there, really having the NASDAQ 100 being driven higher, now near session highs, up as much as 1%. Bloomberg's Abigail Doolittle, we thank you so very much for all the context. And coming up next, bracing for tariffs. Peterson Institute senior fellow Mary Lovely joins Wall Street Week to talk about the potential impact of Trump's proposals. This is Bloomberg.
Time now for our daily Wall Street Week conversation. President-elect Donald Trump says he will impose import tariffs on a number of countries when he returns to the White House, including Canada, Mexico, and China. David Weston spoke with Peterson Institute for International Economics senior fellow Mary Lovely about how Trump's policies could impact U.S. trade.
Although we need to focus on the actual drivers of the trade deficit, not some illusion that comes out of accounting identities. So really, a trade surplus is the excess of your saving over investment. So that can change when your savings rate changes or when your investment rate changes. The U.S. has had very healthy investment, and that's good. Our saving, though, has gone down. So we have a relatively low savings rate comparing across countries. And part of that is due to low private savings, but also low government savings. So here we get back to the large federal budget deficit and evaluating whether you think that deficit is something that should be made smaller.
Donald Trump, when he was president the first time, and now when he's about to be president again, has really emphasized tariffs as a way of addressing the trade deficit. I must say, President Biden did not pull a lot of those tariffs off. He continued with them. What do tariffs do to that surplus or deficit?
Yeah, I think there's a misunderstanding of thinking that tariffs, because they'll lower our imports, will change our trade deficit. And a trade deficit is really a net value between what we import and what we export. Unfortunately, tariffs affect both sides of that equation. They may lower our imports, but they'll also lower our exports. And the mechanism by which that usually happens is a price. It's the exchange rate. So if President Trump goes ahead and put on tariffs, we would expect that the U.S. dollar will strengthen. That will make our exports less attractive to foreign customers, to buyers abroad who have to pay more for them. And so both imports and exports can shrink, and the balance could very well be unaffected. So it may have zero effect impact on the trade deficit. It could even increase the trade deficit. That is, if we don't handle the underlying drivers, which have to do with domestic saving and investment.
I've seen some economists suggest, just with your analysis right there, that if you really want to address this, if President Trump really wants to address this, he's going to have to put tariffs on and put capital controls on as well to prevent that excess surplus overseas being invested back in the United States, which I guess would limit the growth of the U.S. dollar.
Well, there's a lot of ideas out there that basically mess with market mechanisms that lead to sort of these various flows equilibrating. So you're right to point out that the opposite or the other side of our borrowing is, of course, capital inflows. Just like when we, spend more, we have to sign a loan with the bank or an IOU. So we have these financial flows. We could tax them. And again, it may reduce those flows. It may also reduce investment in the U.S. So what the net effect would be is really hard to say. None of these sort of simple fixes are actually dealing with the underlying problem and may very well have, and almost certainly will have, many negative unintended consequences.
That was Mary Lovely speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. And there's so much talk about tariffs. And as we were saying earlier, no one really knows what's actually going to happen. This could all be just a negotiation tactic in terms of the tariffs that Trump has announced on Truth Social, his tariff intentions. And I think that's why the market seems to ignore this.
Yes, I would also point out the big take today, because I think it has an interesting roadmap in terms of what to expect over the course of a number of years, to the end of 2026. And one really interesting element, Matt, is this idea of what it would mean for U.S. imports and exports, not just what we're bringing in, but also bringing out. And the idea is you would really be dropping that balance from 21% to 18%, which does draw questions about growth. But good news is Bloomberg Economics also doesn't expect tariffs to directly hit consumer goods. So this would more so be in the manufacturing sector. Interesting, when you saw the manufacturing data come out today, we're still a very weak sector there. Does it really boost manufacturing in the United States or not?
Yeah, it'll be interesting also to see what kind of retaliation we see. Remember last time, Harley Davidson, Levi's, Jack Daniels all got hit with European tariffs. And we wish those companies well. We are continuing to watch a market that is climbing for tech stocks. If you look at the S&P, we're not doing as much because we're weighed down by financials, weighed down by oil producers, weighed down by healthcare. But in terms of the tech stocks, it looks like gains of about 1% right now on the NASDAQ. We'll continue to tell you more about ETFs and inflows when we come back. This is Bloomberg.
Holiday shopping off to a strong start with solid online sales, helping offset mixed results from brick and mortar shopping. That's according to the latest data from Adobe and Bloomberg Intelligence. Inflation-focused shoppers are taking advantage of deals to maximize their holiday budgets. Joining us now for more, Bloomberg retail correspondent Emily Cohn. You think about what we saw here, people buying online. Does that create a problem for the people that are looking to draw more traffic into stores?
Yeah, so one thing we were looking for this year was a lot of the big retailers were looking to revitalize brick and mortar and get people back into stores. We saw a lot of doorbusters from retailers who hadn't done doorbusters in years, exclusives. Target had Taylor Swift's book as an in-store exclusive on Friday, but it really didn't do a whole lot to get sales back up and running. We heard from a lot of consumers who were saying they were disappointed with the deals, people who said, I got the best deals in the 2 weeks leading up to this. Black Friday shopping is just not worth getting up early for anymore on Friday. People are coming to stores later, shopping online. The day has changed a lot.
Well, and we just saw that data. I mean, it doesn't look that fantastic to me. And I was reading MasterCard's data earlier. They saw a 3.9% gain this Black Friday over last Black Friday, but that was not inflation adjusted. So pretty much all of it was just a rise in prices,
exactly.
Right? beyond that, we're not seeing real growth in terms of the sales. Why is that? Are the discounts not big enough? Are the products not interesting enough?
Yes, discounts were not as good this year. I think they're coming in around 28%. We were expecting about 30%. So the sales just aren't good. If you think about it, the discounts are down and the sales are up. People are spending more because prices are higher, not because they're getting excited about the sales.
It's interesting. I saw that 28% discount in the Salesforce data, which is actually down 2% from last year. So to your point, the data is actually for sales going in the other direction. How does that set up for holiday season shopping?
So I think probably one of the things that is affecting this is the fact that the sales season is getting longer and longer. So Amazon's moving its deals day, its Black Friday into October with Prime Day. So those deals are just more spread out. So in terms of the holiday shopping season in general, Black Friday is no longer the kickoff of the season. It's this midpoint that still holds a lot of weight. Retailers rely on holiday shopping. The whole season is about 20% of their year-round sales. But Black Friday is more of that midpoint than like the kickoff and the Super Bowl of shopping.
I mean, I started shopping on Wednesday, I won't lie.
Do you?
Yeah.
I mean, you're shopping all the time.
Yeah,
let's
true.
be honest. And also, you're doing it mostly online, right?
Yeah.
I mean, you're not going into the Boot Barn. You're typing bootbarn.com.
No, I'm going on Instagram and getting totally swept up by the ads.
Yeah.
Do you find a lot of that happening? Do you find that people are bypassing the main websites completely?
Yeah, that influencers guiding this. I mean, I think like a lot of the fun that used to be had by waking up early on Friday and getting in line and having coffee and doorbusters, that's all gone. Now people are coming to the malls later in the afternoon. They need a break from their family, but they slept in Friday morning and did that shopping on Instagram or going directly to websites.
Matt, I went bowling instead on Friday.
You did?
I did.
Good for you.
Old school bowling alley.
That is awesome. Although that's also not cheap, right? I mean,
no, but my sister paid for it.
Okay.
Did you do it at a mall?
Importantly, no, at an actual
standalone.
Yeah, in Upper New Jersey, Bergen County.
I got to get the address because I love bowling as well. I wonder why we're not seeing as much discounting as we had been. Is it just that manufacturers are confident they're going to sell enough of their product? Have they already gone from red to black this year? Why aren't they offering the big deals?
I mean, one of the things that they have to contend with is a longer season, right? So they have to stretch out those deals, make them last longer. You can't go as quick and deep as a cut if you're offering sales for 2 months.
Emily, we have to leave it there. We thank you so very much. Looking forward to the rest of this elongated season. That is Emily Cohn of Bloomberg News.
Did I ever tell you about John Farrow going bowling with me and my brothers?
No. I can't imagine
we took Farrow bowling, and I feel like he may have come in last place, right? And then a month later, he calls up and says, "Can we go bowling again?" And he had actually taken lessons to win.
Really?
He came back the second time and beat all of us.
That's overachieving. It explains a lot. Well, anyways, beyond that, I want to switch gears for just a second. Speaking of winning, really interesting story here, Matt, on the Bloomberg terminal on the hedge fund winners and losers coming out of the season, betting on the Trump trade. Balyasny just blowing a lot of these funds out of the water. Brevin Howard up almost 9% through November. Bally up almost 4%. But Citadel, we were talking a lot about Ken Griffin in the last month. Citadel Tactical Trading in 2024 up 20%. The gains in November kind of muted, only up about 1.6%. But you can see the hedge funds really are coming back. And the cross-asset Trump trade has been a very big part of what has brought them these kinds of returns.
I have to say, look, Discovery Capital obviously really winning, and Rocos doing well. But the rest of them, I guess it's fair if in bad times they're also not doing as badly, but they're just not keeping up with the S&P 500, right? So when you see Balyasny is doing so well, but they're only up 11.6% year to date, and you can get 26.5% on the S&P 500, it makes me wonder why people are invested in these things.
Pour one out for the index funds, but, and you've seen a lot of flows there as well, they say to invest in a hedge fund is too heavy. hedge, not to get those.
I get it, but it just doesn't seem like it turns out that way when the markets crash.
Particularly after that 2 and 20, 3 and 30, whatever you want to call it.
Absolutely, when they take that much. All right, in terms of the markets right now, we are looking at big gains for the tech-heavy index, although not as much as we had earlier, seeing 1% gain on the NASDAQ 100. You do see those mega-cap tech companies doing well, led by Microsoft, adding the most points. But you see the S&P not doing quite as well because JP Morgan takes away the most points. You're also seeing oil producers and healthcare drag on that index. Coming up tomorrow on Open Interest, we speak with Nancy Tangler of Laffer Tangler, as well as Cliff Asness of AQR Capital. Definitely don't want to miss that interview. Thank you very much, Sonali. This is Bloomberg.